Welcome back, Better Agents. In today's video, we're talking about a subject that's often discussed in all the different Facebook groups for insurance agents, and that is, what sort of compensation plan should I have for my producers? We surveyed 292 of the nation's top independent insurance agency owners to get their perspective on how they're paying their producers, and we're gonna break down the results here in this video. Now, one thing I'll say is, I'm gonna throw out a lot of numbers and percentages in this video, and I know that can get a little confusing and overwhelming. So to make things easier, I'm gonna go ahead and put everything that I talk about down in the description below so you can read through those results. And before we get into the video, make sure you're subscribed to the channel, like this video, and comment down below. Let me know your thoughts on these different compensation plans. To give you a little bit of perspective on the 292 agency owners that we did survey, over 32% had an agency that was older than 20 years, and over 20% had an agency that was older than 10 years. So these aren't just random scratch agencies, these are well-established agencies that we talk to. The average employee count for producers only, not CSRs or anybody else, but just producers, the average employee count was 9 producers on staff. So how are these agency owners paying their producers? We found that 55% are paying their producers with a salary plus commission. Compare that to 44% who are paying their producers commission only. The average salary for a producer is $2,750 a month on top of whatever commission that they write. Now, it should go without saying that if you're gonna pay somebody a salary, it really depends on the area that you live. Somebody that lives in downtown San Francisco is probably gonna make a higher salary than somebody who lives in Topeka, Kansas.
I have a feeling we're not in Kansas anymore.
One of the false assumptions that I had was thinking that a lot of agency owners were utilizing a draw system for the salary, meaning they're gonna pay them a salary until their commission reaches a certain level, and then they'll pay them commission only. I thought that's how a lot of agency owners were paying their people. I found out that only 7.5% of agency owners were utilizing any sort of draw system. Another interesting stat, out of the 44% who said they pay commission only, 76% of those people said that they paid commission only after 3 years in the agency. So for the first 3 years, those producers were getting salary plus commission, and then after the 3-year mark, it went to commission only. When analyzing the commission structure, 87% of agency owners said that they paid their producers a flat commission regardless of monthly premium volume. 10.8% said that they used a tiered system when it came to paying commission. So if the producer hit certain levels of production in a month, then the commission numbers changed. We wanted to dive deep and figure out what the percentage split was between producer and agency, and found that on average, agency owners are paying their producers 40% of all new business revenue. Now keep in mind, the keyword there is agency revenue. It's not 40% of the premium that they write, but it's 40% of the revenue. So if you get 15% on a $1,000 policy, your agency revenue is $150. Agency owners on average are paying 40% of that number to their producers. I think this is a competitive split. I mean, if you think about it, agency owners are taking more of the risk. They got more expenses, whether it comes to E&O, marketing, overhead. I think a 60-40 split, that's a pretty good deal. The next one is a shocking statistic to me, because if you'd asked me this question, I would have bet the house that the answer would have been the other way around. We found that 84% of agency owners are indeed paying their producers a renewal commission. My assumption was that agency owners weren't paying renewals because that's the benefit of being an agency owner. You take more of the risk, you get more of the reward. If a producer wants renewals, they can go start their own agency. But when I saw that 84% of producers are getting renewals, that just kind of blew my mind a little bit, because I would have totally guessed that to be the other way around. The average revenue split on a renewal for a producer is 35%. There were some people that were paying about 50%. There were some people that were paying about 20, 25%. 35% is the average split on renewals that producers are getting on the renewals. And when you think about it, it's not that off the wall. The whole idea is that you want to attract good business. And the way that you attract good business is you compensate fairly on renewals. If someone's just going to get paid on new business, they're going to slap everything on the books that they can.
Slap me around and call me Susan.
But if you tell them that there's incentives for getting that business to renew, and if you put in other qualifiers like loss ratio, cross-selling, account rounding, all of those things, that makes a lot of sense. You want to attract good business. It just really took me by surprise that many people were getting renewal revenue from their agency owners. The next one really shouldn't be a shocker, and that is that agency owners were charging back producers if a policy canceled mid-term. So if they paid out a commission and then the policy cancels 3 months later, they were calculating a chargeback in that production. 44% of agency owners are doing a bonus plan when their producers hit certain production goals. Bonuses range from spiffs, which are usually a flat amount of money, to paid time off, to taking everybody out to their favorite lunch spot. 67% of agency owners are allowing their producers to take place in a contingency bonus plan. So if a carrier is paying a contingency bonus to the agency, producers are allowed to take place in that if certain production requirements are met and loss ratio limits are low. There's really no right way or wrong way to pay a producer in your agency. There's a lot of different variables that go into it. Location, experience, type of business that you write. What you need to figure out is what's profitable for your agency. And if you want to attract good talent, you got to get a little bit of creative. You can't be afraid to pay for good talent, because when you pay for good talent, you get good results. So make sure you're having a good compensation plan. Create other creative avenues where either they get contingency bonus, renewal revenue, or even equity in their book of business or in the agency itself. This is a great way to attract talent to your agency. Whatever compensation plan you settle on, I would encourage you to keep it simple. Neither you nor your producer should have to have a calculus degree to figure out how much compensation they need to be paid. You just need to make it simple, make it easy, reduce the friction. You shouldn't have to spend all day or 2 days figuring out payroll. Just make it simple. Make sure everybody's on the same page so that they can do their job without fear or worry or anxiety. They can just hit the ground running. Make it simple. I hope this video helps you. Again, I've put all the information down in the description below to make it a little bit easier to read through. Make sure you're subscribed to the channel. Make sure you like this video. Share it in any Facebook group where you see compensation being brought up, and we'll see you again on the next video.